Hello traders, welcome back to another episode of the comprehensive course on options trading. In the previous episode, we have discussed in detail about the working of an options contract. We have touched upon the overall framework and the basic aspects of an options agreement. But in this episode, we will try to decode a few more concepts and jargons related to options contract. For this, you will require a fair understanding about options contract and how they function. So make sure you watch the first episode of this series. In this episode, we will look into some of the concepts like derivatives, underlying price or spot price, strike price, lot sizes, exercising of an option contract, types of option exercise, option expiry, option premiums, and finally option settlement. So this video is going to set the tone for all the upcoming episodes because without the knowledge of these concepts and without understanding these jargons, you will not be able to navigate through the murky waters of options. I can guarantee you that this will not only strengthen your basics, but it will also make the upcoming discussions on options very easy for you. So make sure to watch the video till the end. Also support our efforts by liking and sharing this video, and also subscribe to our channel for more trading related content. So without wasting any time, let's get going. We will begin our discussion with derivatives and underlying. Assume a stock like Reliance, which is listed in the stock market. Do you know why people buy and sell this stock? The reason is very simple. The stock carries a value. It represents ownership. When you own Reliance stock, you become the shareholder of the company. When the company performs well, meaning it is consistently generating higher revenues and earning more profits, more people would become interested in taking part in the company's growth. These investors would shell in more money and they would be willing to buy at even higher valuations. This will result in the stock prices going higher. On a similar note, if the company's performance slows down or lags, or if the company takes too much debt, people would not be excited to buy more or retain their ownership. Instead, they might shell off the shares at even lower prices, resulting in a decline in the stock prices. So in short, equity stock prices are directly related to the performances and events related to the company it represents. So there is a tangible entity backing these stock prices. Now think about the options contract of Reliance. There are call options and put options of Reliance. What are they and where do they get their value from? Simply put, these options are derivatives. As the name suggests, a derivative is a financial security whose value is dependent upon or derived from one or more underlying assets. The derivative itself is a contract between two or more parties, as with call and put options, futures contracts, etc. And the price of these derivatives are determined by fluctuations in the underlying asset. In this case, the value of Reliance call and put options are derived from the Reliance stock prices. Or in other words, the Reliance stock is the underlying asset which provides the value for the Reliance options and futures derivative contracts. Now, derivatives can be of different types based on the underlying asset that it tracks. It can be stock options, where the derivative contracts track a particular stock. Reliance option contracts are a good example of stock options. Then there are index options. Here, the underlying asset will be an index. For example, Nifty, Bank Nifty, Fin Nifty, etc. are popular Indian indices. So index options track these indices. The next type are currency options. And as the name suggests, these derivative contracts track currencies. And finally, there are commodity options. The underlying asset for these derivatives are the prices of commodity futures like gold futures, silver futures, crude oil, etc. So the key point to note here is that without an underlying asset, derivatives cannot exist, just like how equity stocks cannot exist without a company to back it up. Now, understanding the underlying price of an asset becomes really easy. As we know, a derivative contract derives its value from an underlying asset. The underlying price, also known as the spot price, is the price at which the underlying asset trades in the spot market. For the Reliance example that we have just discussed, Reliance was trading at 2,720 rupees in the spot market. This is the underlying price or the spot price of Reliance. Now, for a call option, the underlying price has to increase for the buyer of the call option to benefit. While for a put option, the underlying price has to decrease for a buyer of the put option to benefit. Now, let us understand the concept of strike price. So, consider strike price as an anchor price at which the option buyer and seller agree to enter into an options contract. Let us understand this using an example. For instance, Reliance is trading at 2,720 rupees in the spot market. Assume a buyer is bullish on Reliance and he is willing to buy a Reliance call option of 2,740 rupees. Here, 2,740 is the strike price. What it means is that he believes that the Reliance stock will rise above 2,740 before the call option contract expires. It also indicates that the buyer is willing to pay a premium amount today to buy the rights of buying Reliance at 2,740 rupees on expiry. Similarly, if a buyer has a bearish bias on Reliance for the short term, then he will be willing to buy a Reliance put option of 2,700 rupees. Here, 2,700 is the strike price. What this means is that he believes that the stock will fall below 2,700 before the put option contract expires. It also indicates that the buyer of the put option is willing to pay an upfront premium today to get the right of selling Reliance stock at 2,700 on expiry. In fact, here is a screenshot from Fire's app where the different strike prices of Reliance and its associated premiums are shown. If you are a regular options trader or you are into intraday trading, then Fires is the best platform for you. You can trade directly from your charts and you can modify your positions without having to switch between different tabs. This feature is available on all devices including smartphones and tablets, and the trade executions are lightning quick. You can also use a lot of premium trading view features. It also has a pop-up option chain for quick and efficient trade entries. There is no account opening or AMC charges, so try out Fires now. The link is in the description. Now coming back to our discussion. If you don't want to use this app, don't worry, because I will use the data provided by the NSE website so that everyone can follow along. The beautiful table that you see on the screen is called an option chain, which is basically a list of all the different strike prices available for a contract along with the premiums for the same. Besides this information, the option chain has a lot more trading information such as open interest, volume, bid-ask quantity, etc. For the time being, I suggest you ignore all of this and focus only on what is highlighted. The highlighted rectangle shows the price of the underlying in the spot market. And as you can see, the Reliance stock was trading at 2,720 rupees per share. Now, this highlighted section shows all the different strike prices that are available. We can see strike prices from 2,360 to 2,940 with 20 rupees interval between any two consecutive strike prices. And to the top left, you can see the heading named call, and to the top right, you can see the heading named put. Do remember that each strike price is independent of the other, meaning the premiums vary between different strike prices. In addition to this, the premiums required for put and call option contracts of the same strike prices can be different. One can enter into an options agreement at a specific strike price by paying the required premium. For example, you can enter into a 2,840 call option contract by paying a premium of 8.5 rupees as highlighted here. Now, as per definition, this entitles the call option buyer the right to buy Reliance shares at the end of the expiry at 2,840 rupees. And you may already know under which circumstance it would make sense to exercise his right to buy Reliance at 2,840 at the end of the expiry. He will only exercise his right if the Reliance stock price rises above 2,840. Likewise, you can enter into a 2,580 put option contract by paying a premium of 5 rupees as highlighted. It means the buyer gets the right to sell the stock at 2,580 at the end of the expiry, and he will only exercise this right if the stock falls below 2,580. Now, unlike stocks where the minimum purchase quantity is 1 unit, option contracts are to be traded in lots. Different assets will have different lot sizes. In short, a lot size refers to a fixed number of units of an asset being traded. For example, in the case of a Reliance stock, the lot size of its option contract is 250 shares. Or in other words, one lot of Reliance is equal to 250 shares. This is the minimum quantity eligible for trading with Reliance options contract. Let's take another example, this time for an index option like Nifty. The lot size of Nifty futures and options contract are 25 shares. So one lot is equal to 25 shares. This significant change in the lot size with respect to Reliance example has to do with the market price of the underlying asset. So as the price of the underlying asset increases, the lot size decreases. Just take a look at this screenshot of MRF futures trading close to 1.3 lakhs. It has a lot size of just 5 shares. I hope you have understood my point. Another important concept associated with option contracts are expiries. Every contract has an end date, after which the contract ceases to exist or it becomes invalid. In India, the index options and stock options are the most traded contracts. The index options, which include Bank Nifty, Nifty, BankX, etc., have both weekly and monthly expiries. This might change in the near future. Anyways, the validity of weekly contracts expires every week, while the validity of monthly contracts expires at the end of every month. To be precise, Nifty weekly options expires every week on Thursday, while Nifty monthly option contracts expires at the last Thursday of every month. Now, if Thursday is a holiday for some matter, then the expiry would happen on the previous day, which is Wednesday. Now, stock options on the other hand only have monthly expiries. In fact, both equity futures and options contract expire on the last Thursday of every month. Just like futures contract, options contract also have the concept of current month, mid-month and 4-month expiries. Let us consider an example to understand this. This is the option chain of Asian Paints for the month of August. If you click on the expiry date menu, you will see different expiries for 3 months. These are August, September and October. Therefore, August is the near month or the current month expiry, while September is the next month or mid-month expiry and October is the 4-month expiry. One observation you can instantly make is that the mid-month and 4-month expiries have way less participation compared to the current month expiry. Similar is the case with index options, but there we will also have weekly expiries associated with the current month, mid-month and 4-month contracts. In addition to this, there will be other yearly contracts also, which is not really of any use to us, as long as we don't plan to take a very long-term bet in the market. Also, these contracts are less liquid and there will be considerable slippages associated while trading them. Consider this example of Nifty contracts. If you click on the expiry date drop-down menu, you will see a lot of expiries. But we will only focus on the contracts from August, September and October. As you can see, weekly and monthly contracts are available. Just like with stock options, there is a decreasing trend in participation as the expiry date moves away from the most current contract. This is quite evident as the current week expiry is traded more than the current month expiry. Now let's move on and understand the idea behind exercising of an options contract. As per definition, exercising of an option contract is the act of claiming your right to buy or to sell the option contract at the end of the expiry. In simple terms, exercising involves either the physical settlement or physical delivery of shares or the settlement of the cash differential by the seller to the buyer of the contract. If you ever hear the line exercise the option contract in the context of a call option, it simply means that the buyer is claiming the right to buy the stock at the agreed strike price. Clearly, you would do it only if the stock is trading above the strike price. On a similar note, exercising an option contract in the context of put option, it simply means that the buyer is claiming the right to sell the stock at the agreed strike price. You would only do it if the stock is trading below the strike price. Now, exercising of options can be done using any of the two following styles. It could be an American style option or a European style option. Initially, when option was introduced in India, both these types of options were available. All index options like Nifty, Bank Nifty options were European in nature and the stock options were American in nature. The difference between the two is mainly in terms of the options exercise. The American style options can be exercised at any time on or before the expiration date. This settlement is dependent upon the spot price at any given moment and it is not really dependent on the expiry. This offers more flexibility and can be advantageous if the underlying asset's price move favorably before expiration date. On the contrary, European style options can only be exercised on the expiration date itself. This settlement is based on the value of the spot price on the expiry day. This means the physical settlement or delivery of shares or cash differential settlement can only happen on the day of the expiration. So it is less flexible than the American style options. Now, India primarily follows the European style options for its derivative markets. This style is used both for stock and index options in the Indian markets. Assume there are 10 days to expiry. You buy one lot of Reliance 3000 call option when the Reliance stock is trading at 2950 rupees in the spot market. Further assume that after you buy the 3000 call option, the stock price increases to 3100 rupees after 3 days. Under such a scenario, the option buyer cannot ask for a physical settlement, or he cannot exercise his right to buy the shares at the strike price against the call option he holds. Settlement will only happen on the day of the expiry based on the price the asset is trading in the spot market on the expiry day. So the important point to note here is that you can exercise the option only on the day of the expiry and not any time before the expiry. As mentioned earlier, exercising is different from trading options. Exercise of options involves either physical delivery of shares or cash settlement of the differential, while trading of options involves the simple buying and selling of contracts before expiration. We will discuss about option settlement at the end of this episode. Now let's talk a little about options premiums. Since we have discussed premiums on a couple of instances in the previous episodes, I guess you have a fair understanding of what options premiums are. So premium is nothing but the money required to be paid by the option buyer to the option seller or the writer. Against the payment of premium, the option buyer buys the right to exercise his desire to buy or sell the asset at a predetermined strike price upon expiry. If you have a good clarity till now, then we will proceed to understand a whole new perspective on options premium. To be frank, the whole idea of options theory hinges upon options premium. It plays an extremely important role when it comes to trading options. Option premiums are not just random numbers. There are several factors which affect the premiums. For easy understanding, let us revisit our previous real estate example on the bypass project and its influence on the price of a housing project. If you have no idea on what I am talking about, I suggest you watch the previous episode where we have understood options contract using real life examples. In the real estate scenario, the rumors regarding the bypass road project were only speculative and no one had any clarity whether the project would come up or not. Since the news was purely speculative, hence the developer of the housing project was happy to accept 1 lakh rupees as an upfront premium. However, for a minute, assume that the rumors were not speculative and there was some sort of assurance. Maybe there was a government official who hinted in the recent press conference that they may consider a bypass road to divert the traffic in that area. With this information, the news is no longer a rumor. Suddenly, there is a possibility that the road might indeed come up, but there is still an uncertainty as to when. With this information, do you think the developer would accept 1 lakh rupees as premium? Most probably, he will turn down the offer because he knows there is a good chance for the bypass road to come up and therefore the land prices would increase. This will in turn increase the value of the house. However, because there is still an element of chance regarding when the road will be sanctioned, the developer might be willing to take a risk provided the premium will be more attractive. Maybe he would consider the agreement attractive if the premium was 3 lakhs instead of 1 lakh. The second factor to take into account is the time. As per the contract agreement, there was 3 months' time to get clarity on whether the bypass project would become a reality or not. Since there is more time to expiry, the possibility of the contract working out in the buyer's favor also increases. If there is 3 months' time, clearly the buyer knows that there is ample time for the truth to emerge with respect to the bypass road project. This means the seller will be taking up more risk as the bypass road project could get sanctioned and the property prices could surge. So the seller might demand higher upfront premiums. However, instead of 3 months, what if there was only 15 days time? Since the contract period has shrunk, there is simply not enough time for the events to unfold. This scenario will favor the developer or the seller. Under such a circumstance, where the time is not on the buyer's side, the buyer would not be happy to pay 1 lakh rupee premium to the writer, as there is no incentive for the buyer to pay that kind of premium to the developer. Maybe he could offer a much lesser premium, say 20,000 rupees instead. Now, let us consider these ideas from a stock market perspective. Assume Tata Power stock is trading at 445 rupees today. One lot of Tata Power 460 call option with 1 month expiry is trading at rupees 10.5. Now, as an options writer, would you enter into this agreement by accepting 10.5 rupees per share as premium? Now, if you enter into this options agreement as a seller, then you are giving the right to the buyer of the contract to buy Tata Power shares at 460 rupees after 1 month down the lane from now. Let us assume that for the next 1 month, there is no foreseeable corporate action which could trigger the share price of Tata Power to increase. Considering this factor, maybe you could accept the premium of 10.5 rupees. However, what if there is a corporate event like the quarterly results that could increase the stock price? Will an option seller still go ahead and accept 10.5 rupee as premium for the agreement? Clearly, it may not be worth the risk for 10.5 rupees. But what if, despite the scheduled corporate results, a buyer is willing to offer 30 rupees as premium instead of 10.5 rupees? Then it might be worth taking the risk, right? Now consider a similar scenario, but for the Nifty index option with a current week expiry. Let's say Nifty is trading at 24,400 rupees. Assume there are only 4 days to expiry. One lot of Nifty 24,600 call option with the current week expiry is trading at 82 rupees. Now, as an option buyer, would you be willing to pay 82 rupees as premium with the expiry happening in just 4 days? Most probably, you would not take the bet because the time is not in your favor. But if the sellers would have asked for a reduced premium, like 30 rupees, then buyer might think about taking the risk. So the point that I want to make here, keeping the effect of both news and time in perspective, is that option premium is never a fixed rate. In real markets, premium vary almost on a second by second basis. Premium is sensitive to several factors. Some of these factors tends to increase the premium and some tend to decrease it. And in real markets, all these factors act simultaneously affecting the premium. To be precise, there are 5 factors that tend to affect the premium. These factors are called the options Greeks. We are too early in our course to understand Greeks, so we will talk about Greeks at a much later stage in this course. The other point to keep in mind is that the premium of options changes as and when the expiry changes. Just like futures, there are different option expiries and the premium is not the same across different expiries. Now, let us wind up this episode by understanding the concept of options settlement. Let us consider the following call option example in the market context. This is a call option to buy the shares of Reliance Industries at 2,700 rupees. The expiry date is 31st October 2024 with a premium of 24 rupees per share. The market lot is 250 shares. Now, let us assume that there are 2 traders, Trader X, who is the option buyer, and Trader Y, who is the option seller or writer. Trader X wants to buy this option and Trader Y wants to sell it. Given the contract is for 250 shares, here's how the cash flow would be structured. Since the premium is 24 rupees per share, Trader X will need to pay 6,000 rupees to Trader Y. The seller gets to back this upfront premium, but he is now obligated to sell Trader X 250 shares of Reliance on 31st October 2024 if Trader X decides to exercise his agreement. On the day of the expiry, if the market price of Reliance Industries is 2,800 rupees, then Trader X will exercise the option to buy 250 shares at 2,700 rupees, thereby benefiting from the difference between the market price and the strike price. Here, I would like you to understand that there are 2 ways in which the settlement can be carried out. This could be a cash settlement or a physical settlement which involves physical delivery of shares. In India, index option contracts are primarily cash settled, meaning they are settled in cash rather than through physical delivery of the underlying asset. For index options like Nifty 50, Bank Nifty, etc., the settlement is cash based only. For a call option on the expiration date, if the spot price is greater than strike price, then the difference between the market price of the index and the strike price is settled in cash. However, for some specific contracts, physical settlement is mandatory. For example, for stock options, the options are to be settled physically upon expiry. This means that if the option is exercised, the seller needs to deliver the underlying stock to the buyer, and the buyer has to pay up the strike price for the shares. The stock exchanges have specific guidelines and regulations detailing how and when physical settlement is required. But normal traders like you and me won't wait till physical settlement, as it is more complex and requires certain guidelines to be followed. Anyways, here is how the physical settlement would have taken place for the Reliance example. On 31st October 2024, Reliance is trading at 2,800 rupees. This means the option buyer or trader X will exercise his right to buy 250 shares of Reliance at 2,700 rupees, which is the strike price of the agreement. In other words, he is getting to buy Reliance shares at 2,700 rupees when the same is trading at 2,800 rupees in the open market. Once trader X exercises his right to buy 250 shares from trader Y, the price at which this transaction will take place is the predetermined strike price of 2,700 rupees. So trader X has to pay a total of 6.75 lakhs to trader Y. Against this payment, trader Y will release 250 shares of Reliance at 2,700 rupees to trader X. Trader X, who is the buyer, will almost immediately sell these shares in the open market at 2,800 rupees per share, and he will receive 7 lakh rupees. Trader X makes a gross profit of 25,000 rupees in this transaction. Another way to look at it is that the option buyer is making a profit of 100 rupees per share, but the net profit is obtained after adjusting for the initial premium paid. The option buyer had initially spent 6,000 rupees towards purchasing this right, hence his real profit would be 19,000 rupees. In fact, if you look at it in a percentage return terms, this turns out to be a staggering return of 317%. The fact that you can make such large asymmetric returns in a single trade is what makes options an attractive instrument to trade. This is also one of the reasons why options are massively popular among traders. Now, for those who prefer not to engage in physical settlement and the headaches associated, it is possible to avoid it by closing or squaring off your open position before expiry. This can be done by trading out of the open position before the final day to settle in cash, thereby avoiding the need to arrange the underlying shares or the funds required for delivery. Now, coming back to index options, in India, as I have mentioned, index options are cash settled rather than physically settled. The primary reason for this is that index options, unlike stock options, do not have an underlying asset in form of physical shares, so they cannot be settled through physical delivery. At expiration, index options are settled based on the difference between the option's strike price and the closing price of the index on the expiration date, resulting in a cash settlement. So these are all the important concepts that you need to know regarding options contract. In the upcoming episodes, we will understand in depth about call and put option contracts. Meanwhile, help this video achieve the target likes. Hit that like button right now. Comment down your queries and suggestions. Also share this video with your friends and fellow traders. If you are new to our channel or you have not yet subscribed, please make sure to subscribe and support our efforts. Also enable the bell notification to stay updated about new video uploads. I will see you guys in the next episode. Till then, bye.